Share the sound. Not that one. This one. And this one. The difference here is it's not a continuity structure where you're selling something and moving it to another thing you're owning. It's an exit plan.
So my understanding is that I can create a trust, transfer the assets to the trust, functionally sell the assets, even though I'm not, I guess, technically doing the one selling it. You have a trustee managing that. As long as you don't receive the gains personally, you can keep the assets in the trust. First of all, is that a fair summary? Maybe some of the nuances.
Exactly.
Okay.
You actually nailed it on the head, but let me just do some clarifying pieces in between there, right? So what you're doing is you're lending the funds to the trust, and so we're actually doing a cryptocurrency deal right now.
Okay.
Gentleman bought Ethereum for 100,000. It's worth about 12 million. We're gonna take the first 5 million, and he's gonna transfer it from his Kraken account to the newly formed trust account. But he's not going to exchange it. He's not going to have that other account pay him anything. In fact, it's going to be just a direct transfer. Kind of like if you were to transfer funds to a qualified intermediary if you're doing a 1031 exchange. Kind of like that. Kind of like if you were to put funds into an IRA. Kind of like if you put funds into a 401k. The difference here is it's not a continuity structure where you're selling something and moving it to another thing you're owning. It's an exit plan where you're literally exiting your position in exchange for a promissory note and becoming the lender. So in this scenario, he'll be owed back the 5 million plus a rate of return, but he hasn't received any of the 5 million, right? So therefore it's in a deferral state, kind of like an IRA, kind of like a 401k, kind of like a 1031.
Okay. I actually did not know that. So that makes sense. So basically you're transferring the assets to the trust, but the more appropriate way to say that is that you're lending the assets to the trust. Is that fair?
Exactly.
Okay. And the trust can pay you back. And when you do receive those payments, you are going to be taxed at capital, or I guess income level at that point.
Or tax deferral, not tax avoidance, right? This is very important. This is why the IRS looks at this. It's IRC 453 based upon 90-year-old tax law, which is an installment sale. So you're saying, look, IRS, I owe tax liability on that $5 million, right? Let's say in this scenario, it's 2. I know I owe that to you. And the government says, yes, thank you, Hunter, for showing that you owe that to us. But as you receive payments, if it's interest payments, you'll pay ordinary income tax on those interest of the 5 million.
Right.
If you dip into principal, you'll pay capital gains tax. But here's the kicker: that 2 million that you owe the government, it's at a 0 interest rate. So the question is, when would you like to pay 0% interest back to the government? The answer is, I'll answer for you, never, right? You want to keep that in a deferral state. Now, you eventually will pay it, and you'll pay the ordinary income tax. So it's not like we're never going to pay tax. It's just like a 401k or 1031 or an IRA. When do you pay tax on that? Well, when do we start receiving payments? Well, when do you start receiving payments? And this is the key. When does it work for you? A lot of our clients will delay for a couple of years, especially if their income's high. And in the meantime, they can use the funds. They can go back into active or passive real estate deals or stocks, bonds, and mutual funds. Or hard money lending, right? We can diversify the equity into multiple things. So it's perfect for the cryptocurrency person, right? Who's hit the home run lottery on the Ethereum or whatever, right? To sell, diversify, and then get some cash flow going.
Okay.
All right, everybody. Welcome, welcome, welcome. So glad everyone is here. We have a full house tonight. Welcome Anna, who's new. Nicholas is new. Looks like Daryl is new. Is it Emil? Is it Emil? I'm not sure how to pronounce it. Miss Mason, welcome. And of course, welcome our let's see, our regular attenders. We have Mr. Clint Cox, Mr. Warren Strand, and my co-host, Jake Muller, and soon to be taking over the podcast when he gets his Ethernet all connected, Pierce York. Jake and Pierce, how are we doing today?
Wonderful day. Can't complain.
Also, shout out to Rebecca, newly joined EXP family. Welcome to the EXP family, as well as Rockstar Realtor Luxury Agent up in Tahoe, Truckee area. If you're looking to do anything up there, she is your gal. Rebecca, how are we doing today?
Doing great.
Fantastic. And so I'm going to kick us off with a little bit about, if you're joining us for the first time, who I am. Then I'm going to pass it over to my co-host, Jake, and then we're going to dive right in. So my name is Brett Swarts. For those who don't know me, I'm founder of Capital Gains Tax Solutions. I am really, really passionate about helping you and or your clients defer capital gains taxes on the sale of cryptocurrency, businesses, real estate, you name it, public stock, private stock, so you can create and preserve more wealth with your money, have freedom to invest at any time, all tax deferred. We like to say around here at Capital Gains Tax Solutions, it's no longer just about cash flow, it's also about tax flow. Now, it's always been about both, but when it's becoming more and more apparent that it's about high taxes and big challenges with those taxes, and also looking for some opportunities to sell high in a very highly appreciated crypto market, business market, valuation market, and then real estate market and stock market. Now more than ever is the time to diversify, get some liquidity, maybe buy some different assets and time the real estate and crypto market and financial market for that matter. And that's what the Deferred Sales Trust allows us to do. The Deferred Sales Trust goes back 25 years, thousands of closes. I learned about it in 2009, unfortunately, just about 2 or 3 years too late before the real estate market crashed and great 2008 crash. And we learned the hard way of what not to do, which was just doing 1031 exchanges or just not selling, right? When you know you should have been selling. And then we figured out basically this is cool thing called a Deferred Sales Trust that it gives you lots of possibilities and lots of options as long as you follow the rules of which have been laid out with the amazing tax attorneys who are my business partners who created this thing. Those guys are like the brain surgeons. My role is like a third-party trustee. It's part of the process and part of the procedures with this Deferred Sales Trust. I'm also a commercial real estate broker by trade. I grew up in the real estate industry. I love commercial real estate, but it's just not about that. It's also about partnering with amazing people like Jake Miller, he's like all of it. I feel like Jake, part of why I love Jake is his brain thinks and is at a different frequency, which is important, right? You always want business partners who are complementing what you're doing. And that's what Jake brings to the table for my clients and our team. And he trains CPAs. He's a financial advisor. He also loves commercial real estate. He also does some lending and puts things together. He's also done some political stuff, which is kind of cool too. He kind of fell into that. So that being said, Jake, do you want to introduce yourself real fast, or those are getting to listen, and also give the vision for why we're here?
Very good. Obviously, the vision for why we're here is if you have a capital asset and you're possibly going to sell it, otherwise have a transaction which would normally be taxable. With the Deferred Sales Trust, we can help you take that otherwise taxable transaction, roll it over into other assets, if that is your desire and wish, to continue to reinvest and grow your asset. We can switch from asset class to asset class, or even just to one asset to another without incurring those taxes. So we can actually snowball without having to pay Uncle Sam and Aunt Utah or whatever state that you're in. And we can just kind of keep the investment going and push it forward. We, as Brett mentioned, a few of the things that I've done is I've coached CPAs across the country, and the discipline or combined disciplines has been tax advantage wealth management. And so how do you move items from column A over to column B, get a deduction or otherwise have it be non-taxable, and continue to increase your net worth? We can accomplish that with the Deferred Sales Trust. That's one out of many strategies, and typically a keystone strategy, meaning it is something that if we can do that, we do that first prior to other things, because it ends up being such a phenomenal financial tool moving forward. I appreciate the intro, Brett. I almost don't have to say anything else other than that we help people solve problems, or we find solutions to people's capital gains issues. And that is incredibly important in today's environment with the current political discussions, legislative tweets, everything else of what may or may not be in the next tax code. And understanding from a rate of return standpoint, some people are shooting for 6%, 12%, 200%, whatever you're shooting for. If you're not taking into consideration the tax ramifications of your investments, you might be losing out on 37 to 50, whatever percent that could have just been given to you through a few perhaps lesser known or commonly underutilized strategies, one of which is the Deferred Sales Trust.
Beautiful. Pierce, you want to introduce yourself too for our listeners? And I've been working with Pierce just real quick. I'm going to give a quick intro. About 6-7 years now, training and mentoring him in commercial real estate and brokerage and the Deferred Sales Trust. And so he goes back a number of years. I'm quickly grooming him to be a top leader in capital gains tax solutions. And he's also a luxury realtor down in Southern California. But Pierce, you want to just touch on the value of the deferred sales trust that you see it for folks that are out there.
Yeah, absolutely. Thanks for the intro. That was real nice. Yeah, so it's just it's a really good competitive advantage. You know, and it's in this particular market where people are, you know, highly, you know, at least in Southern California where people are highly wealthy, they have more than just, you know, tax issues with real estate. They have it with other, you know, stocks, or they have it with businesses that they're selling or whatever. And we're able to come in and provide that solution for not only commercial real estate, but high-end primary homes, businesses, crypto, stock, I mean, even art. So it just increases your value so much, having that like in your back pocket that you can offer somebody else, you know, and it can help get you in the door and open up conversations that you wouldn't normally have.
Fantastic. And so we just covered kind of the vision and the overview and kind of the introduction. And we did a little bit longer today because we have some newcomers. We want to make sure you get started on a good foundation. The second thing we always do is a deal close story of the week, which we're going to transition to right now. And then to look forward on the next thing we're going to be doing, we're going to actually be breaking down. It's week number 2, and Warren's going to be live. Warren and Catherine were live last week, and they'll be live again talking about how to, like, once the deal's closed and you want to invest back into a business or real estate or even cryptocurrency, like, how do you go about doing that in a way that gives you as much upside as you can and gives you back the ownership of that LLC to buy it? And so we're going to walk through that. But that being said, let's talk about the deal close story of the week. So this one comes out of the great state of Oregon, you know. So Oregon has also seen some rapid appreciation and also kind of a mass exodus on a lot of people, especially Portland area. You know, the city has changed a lot. It's, you know, California, some of these cities, you know, as you guys unfortunately probably know, it's you know, there's a lot of unrest. Let's just put it like that. And so he is, this gentleman is close to 70. He is looking at a very high tax liability. He's selling his property. I think at the exact numbers, but I think it was right around 1.2. His basis was very low. He'd owned it for many, many, many years. He's looking at hundreds of thousands of dollars in tax liability. And he's saying, you know what? I don't necessarily want a 1031 and overpay for a property. I've been through that song and dance in 2008. Second, even if I found a property, do I really want to manage a property at this age? No. Would I prefer to spend more time with the grandkids, to travel more, to do whatever else? Yes. And so the Deferred Sales Trust provided that option for him to get liquid, get tax deferred, get diversified. He's going to be putting it into some real estate investments. That's kind of his comfort level. More of like a REIT style for him. But that is his, someone else in here. That is his plan so far, at least for the foreseeable future. And who knows, something might crash. And we always like to say, like, real estate folks, hey, if we find a deal, we like a deal. I'm a real estate investor, commercial real estate investor. We're going to buy that. We're going to find that and do that deal. It's just, we only want to do the deal when it makes sense for us. And so he might get back into the game right now, but right now he wants to be out of Oregon, and he wants to be tax deferred, and he wants to be out of real estate that's active real estate, right? So Jake, any thoughts or feedback on that?
You know, it's a wonderful option in the sense that it provides the flexibility that you can jump in and out of investments, almost as if it were like a qualified account, which it's not, right? But like if I had an IRA or 401k, if I were to, inside of that, sell Apple to buy Google or to go buy Pepsi or Coca-Cola, well, those would not be taxable transactions. And that's what this also allows people to do inside of the trust, is to buy and sell a variety of assets and then roll them over into something else and then roll it over into something else as things get better and better, so that you can continue to snowball the overall asset or corpus of the trust and make things bigger. And that flexibility is something that most people don't have in whatever vehicle or whatever investment umbrella they're currently utilizing. And so having that come to the table, or being able to participate with a deferred sales trust because of your first transaction, usually becomes a continual system, a continual process, of which later today we're going to dive deep into how to use the deferred sales trust on an ongoing basis. And I would say that, you know, like a 1031 is a one-time thing, right? Until like the next 1031 or whatever, right? The deferred sales trust is something that you can use over and over and over again. And it's very beneficial on an ongoing basis.
Fantastic. So that being said, if anyone has questions along the way, I don't want you to lose them. You can obviously just chime right in, but you can also type them in the chat. And if you're like ready to take action right now, you can go to capitalgainstaxsolutions.com. Mention this mastermind when you do. You can also find Jake at alphamarktax.com. Is that right, Jake?
That is correct. alphamarktax.com.
Okay, cool. So just anyone who's ready to take action right now, you can do that. But in the meantime, type stuff in the chat, and then I'm going to be opening it up a shared file here. And then Warren, get prepared. Maybe you want to test your mic out here, and actually in the meantime, Warren, while I'm opening this up, could you just jump on and tell a little bit about how we're working together and what you're looking to accomplish, and then what we're going to be kind of diving in today? Warren, are you there?
Yes, I'm here. We're not on video because our internet is super poor. We kind of live in.
No, your video looks good. You sound good. You just get close to the mic. You look good and sound good. Hey, Catherine, you're there too. Hey, Kat, how you doing?
It has been going in and out, so we were trying to minimize our bandwidth. Anyway,
Okay, well, right now it looks real good. Keep going.
good. So Brett's representing us on the sale of a property right now, and he's taught us about the DST, and we're getting closer and closer to actually moving forward with the sale of this property. And now we're trying to figure out what we're going to do with these funds. And Brett's been kind of helping us, and that's why we're here today, actually, to review how these funds actually
the joint venture and the LLC,
LLCs,
so we can continue to be active in management of property. It's kind of like a drug. You can't just like cut it off. We still want to be active. So
a little bit.
When the timing is right, when the deal is right? But not under the 45-day shotgun wedding, a marriage in 180 days.
Correct. You got it. Correct.
Yeah, very good. Great summary. Thank you so much. And Jake, I also, while I'm pulling this up, I want Jake to walk through just briefly how this works. It's good to hear it from different frequencies, right? And different cadences, right? So Jake, would you walk through for the audience how you understand that the trust partners with an LLC and purchases, real estate or even crypto, right? Walk through kind of just the ABCs here while I'm pulling up the file, okay?
Very good. Well, if anybody's ever participated in a general partnership, limited partnership type relationship, I would say that's the end of the story. But if you haven't, let me explain a little bit how this can work. If we do a joint venture, and why would we do that? Well, there's certain advantages to keeping operational participation from the trust out of the picture. So when I say operational, the trust oftentimes should be viewed as like that rich uncle who's the silent partner who steps in to help make the deal work. All right. So we're going to do and I'm just going to substitute the DST or the trust. I'm going to substitute that with the rich uncle in this example or scenario. If you have a good business venture, a business startup, or a rental property that you want to go purchase, you might do it in a partnership with somebody who has the money, and you might put in the sweat equity, or you might be the operator. You might be the one that goes in and remodels it to fix and flip it, or you just want to kind of join together because you have boots on the ground, eyes on the property, and you can make things happen where the rich uncle is busy and perhaps lives somewhere else and can just participate from a money level. So you team together to make that work. And there's a way of allocating in this type of partnership relationship income, depreciation, expenses that ends up being most advantageous from a tax perspective for what is inside the trust versus what is outside of the trust. And I think that's very high level, very simplistic, and how to explain the teaming up with the trust or the joint venture relationship with the trust and making deals happen.
Good. And then would you just also walk through the 80-20 relationship, and what's that preferred return, Jake? Like, what does that mean? And how does, who gets 80, who gets 20, and who puts up the money for on this partnership?
Very good. So from a tax perspective, we want the trust to burden most of the income. Why do I say burden? That's because when you have a lot of money, you usually have to pay a lot of taxes on that. But if the trust is not a taxable entity at this point, then we want to try to move as much income over to the trust as possible. All right. However, somebody is performing the labor, the effort, the operations, running the business, what have you. So we have to assign some of that to that person or entity, right? So 80% to the trust, 20% to the operator, to the LLC that you have outside. That also allows for us to allocate depreciation to that LLC or to the operator who owns the real estate. So income goes to the trust, depreciation goes to the entity. That way it can offset a lot of that income that you would be receiving through that 20% income and end up being an overall tax efficient move for partnering with the trust. Talking about that preferred rate. So we want to make sure that we don't do anything that looks like self-dealing, right? So the trust, we want to make sure that the trust, if we're moving assets into the trust and then selling them, in exchange, in order to move it to the trust without incurring taxes for transferring an asset, specifically in states like New York and cities like New York, where they put a lot of weight and a lot of focus on transfer taxes, we have to exchange it for something of equal value. And so we do that as a promissory note. And we want it to be a preferred rate because we don't want there to be any like self-dealing in the sense, well, I'm only going to charge myself 1% or 2%. We want it to be not only comparable or considered normal, but almost more expensive than normal to show that we're not giving ourselves an advantage of any kind. And it's actually an okay thing to do. And again, through depreciation and through all these other things, through the joint venture relationship, it's very easy to offset that interest income from that preferred rate that we're going to be offering.
Perfect, Jake. Fantastic. Now we're going to, I'm going to share a screen and we're going to dive in unless someone has a question or thoughts on that, because that was wonderful, Jake. Anyone have a thought or question on any of that?
I would say that sometimes just, the theory or the lecture piece is kind of boring, or it becomes real when we put it on a spreadsheet, like what you have, Brett. It becomes real when somebody has a real life example, which of course, if you're here today, possibly you have a real life example in mind. And feel free to ask about it here on this call, or Brett and I can help you with this offline, and we can definitely run you through a variety of different scenarios that are more specific to what you're going through.
Yeah, and it is a real life example with Warren Cat, and that's what we're doing, right? So, but yeah, if you have one too, after this, we'll dive through this actual deal that Warren has actually flown out to Texas. He's already bought one of these duplexes personally, and he's like, well, the deal's working out. What if we did it with the trust in this scenario? So Warren and Kat, are you ready again? I know we said you're on deck before, but now you're really at the plate.
Yeah, we're here.
Okay, cool. All right. Can everyone see my screen? Okay. Yes. Thumbs up, thumbs up. Okay, good. All right, so this is the property. Okay, so last week we did a kind of a first run at this. It probably wasn't as clear, and I may have moved a little bit too quick. But either way, it's good to have spaced repetition with this. So we're going to do the scenario of just buying it all cash with the trust. Okay, and then we're going to do the scenario of doing some financing by the trust putting up the down payment and the LLC actually obtaining financing. Okay, so as a quick review, Warren and Catherine are the process of selling their $2.6 million multifamily property here in Sacramento. It's up in Placerville. I'm actually listing and selling it. We're hoping to make a deal here by as close as sometime next week. Their challenge is their basis is essentially about $200,000. Okay, which gives them about a $2.4 million gain, okay? And in the state of California, that is substantial, right? That is as much as 40%. And so, option one is you sell and you pay the tax, which is pretty brutal, because that would be about $960,000. Of course, option two is you do what's called a 1031 exchange, and you can roll all of the 2.6 million into another property. And then option three is the Deferred Sales Trust, where we don't have to roll it into a single property of equal or greater value or any short time period, but we can dollar cost average. We can get some diversification. And so as one of those scenarios, we are looking at this property in Texas. And so Warren, I think the main question would be, what would the return look like for the trust on the 80-20 partnership with an 8% preferred return? And let's start with all cash. Does that sound like a good place to start?
Yes.
Okay. So, close of escrow, and this would be the gain. So let's just say approximately, 2.45 after closing costs hits that, and we're deferring $960,000 of tax. And so up to 80% of the funds are available for what's called outside real estate investments. We got to keep some liquidity in the trust, meaning stocks, bonds, mutual funds, but the other 80% is available to go. And so in this scenario, that would mean about 1.96 million. So 1.96 million could be available. But let's just to keep it simple, let's just take, let's say we got a deal at $354,900 is what we purchased the property for, and we just bought it all cash. See, this is the purchase price here. What would it look like as far as a return for the trust? Well, first of all, the net cash flow after taxes, loan payment, there's no loan payment, right? So that's zero. But the monthly rental income is about $1,500 per unit. It's a duplex that they're buying here. So the net yearly cash flow is about $22,740. So on $354,000, 354,500, I think. Oh, 900. We got to talk them down a little bit here. Hopefully we can get them down a little bit. 354,900 at 8%. That would be the preferred return that Jake had talked about in the beginning. 354, 8%. The goal, it's not a guarantee, it's just the goal of 28,320 would be that number. Now the yearly cash flow is only 22,740. So you see how when Jake said, hey, it's preferred that the heavy amount of receiving the income goes to the trust, because guess what? The trust can operate at a tax efficient way. Income tax deferred, capital gains tax deferred, and then the other way to put it is investment return tax deferred. In fact, Warren and Catherine, you would only pay tax if and when you actually receive any cash flow. Now, in this scenario, you have 80% ownership to, I'll put WNC, okay, Warren and Cat, 20% to DST. Now, here's what's important to understand. The DST put up all of the cash, okay? They put up the $354,900 in exchange for, again, hoping to get the 8%. Now, obviously, we didn't get the 8% here, right? So there's a little deficit. In fact, the deficit is this number, and that would carry forward to the next year, okay? And any questions on this part so far? This is the foundation so far.
So far, so good.
Okay. Now you might question me, well, does Warren Cat get paid at all? Well, yeah, they can receive this $22,740, right? From it goes to the DST, and the DST pays them, because the DST, by the way, let's also do this. DST owes WNC. What do they owe? Well, we did the numbers up here. Approximately 2.45 would be in the trust at 8%. So 2,450, 8%. It's $196,000. Okay, per year. Okay, and that's again based upon the 245 number. And by the way, Warren and Cat, what's your cash flow right now? Do you remember your cash flow right now? Your NOI on your property right now?
On an annual basis, about 70,000.
No.
About
NOI.
70?
NOI. No, sorry, about 120.
Yeah, I thought it was about 120, right?
Right.
So current state, and this is common for a lot of our clients who have highly appreciated assets, is there what's called the return on equity. Return on equity, right? And an easy way to put that would be like, if you had $1 of cash flow and it's producing, and the asset value is worth $100 million, right? That's a very low return on equity, right? You could at least have someone take that and you get some kind of a loan off of that, or use that as collateral and get a higher amount. Well, when real estate, what happens is basically you get kind of tied between the cash flow, right? And as the value goes higher and higher, and they bought it for about 1.2 million, and they did a 1031 exchange out of a property in Manhattan Beach. And as the value just keeps rising and rising and rising, at a certain point you go, hey, why don't we capture that equity and let's turn that into $196,000 a year, right? And also potentially solve the problems of, owning in California, which for some people it's big. It could be, new rent control in California. It could be good time to sell. It could be lifestyle, more time and freedom. It could be a number of things, or it could just be, hey, I just want more cash flow. Like if I can increase my cash flow from $120,000 to $196,000, and I can, lower my risk, I could potentially, pay off debt, and I could put myself in a position to purchase at a discount, right? And this is part of what's happening here. They're looking at, okay, well, $1,500 a month per unit, brand new construction in a very pro-business state, right? A booming economy, doing very well in Texas. And so this is part of what they can do to try to achieve this. Now, any questions on any of that, Warren and Kat?
Nope, we're there.
Okay. So back over here. So we've got 8%. That's the preferred return on the 354, which is $28,320, which owes the trust, which again owes you. It owes you the 196. So this 28 is going into this 320 is going into this 196 per year, right? That's the goal. Mm-hmm. And so we have a little shortfall. Well, that's okay. It doesn't necessarily have to always equal the same. In fact, this valuation, it might take 2, 3, or 4 years, maybe 5 years, maybe you sell it. And eventually, let's just say you sell it for $1 million, right? Not likely in Lubbock, Texas to do that, but who knows? So just do the math here. On $1 million, and let's say that took 10 years to do that. Okay, 10 years. That means over the 10 years, this 28,000 number, right, which was the preferred return on the 8, we want to take that by 10 years, right, which is 28,320, 10 times. That's $283,000. Okay, 200, right? And what's left over is equal to the sum of this minus this guy, right? The original amount was just 645. Okay, 645. So then we're going to take this 645 number. Okay, here. Oops, they didn't like that. Let's try that again. Let's go 645, 100. And remember what's been a pent up amount, right? That's been accumulating for all of those years. And you probably have been paying some of that back, to the trust as the cash flow is coming out because it's the preferred return. So the first 283 of this 645, guess what? That goes to the trust, okay, which leaves equal to the sum of this minus this, okay, which is 361, which then just follows the waterfall of, guess what, 80% to WNC, 20% to DST. Okay, so here we go. I got this. And Jake, we gotta get our minds together and create like a DST.
I was gonna say
DST calculator,
yeah,
like
calculator.
On steroids, so we could just put it in there.
Yeah,
I think we could do that. We could probably
absolutely
yeah.
do that.
So this is equal to this times 80%. Oops. I gotta put the percentage sign. Boom. This is equal to the sum of this times 20%. Okay, so again, that would be a cool return right there. This is a percentage sign, not a 5. Okay, Warren Cat, any questions on what just happened? Very important.
Yeah, I guess the main question is,
So
again, the DST is an accrual basis, so it doesn't have to be
Speak closer to the computer and the microphone. And for Christmas, I've already decided. Amazon, I am sending you guys a microphone for Christmas. It's on the way. Okay, Amazon Prime. It's going to show up at your door. But can you speak real close to the mic? Lean in.
I understand that the DST is an accrual basis, so it's not an annual every year type of thing. And so your example here is after 10 years, you sell it, and whatever deficit, you make it up. But the problem becomes, what if the properties, and this is Texas, right? California probably will go up to $1 million, but in Texas, it probably will not. And what if just being contrarian, not positive, what if it doesn't sell for more? What if it sells for less than the deficit over 10 years? What happens then?
Well, in that scenario, let's do that scenario. Let's go ahead and copy this. Let's paste it here. And the market tanks. And it's at that would be 30,000. That'd be really bad. $300,000, right? And essentially there wouldn't be an 80-20, right? So this would be at 0. And at that point, if you sold it at 300, it was owed 283. Then it would, after closing costs, it would barely break even, and then just the money would go back into the trust, right? So in that scenario, there was no upside for you or the trust. It was basically just taking its money back, of which, guess what? It still owes you the money, right? Remember, this 80-20 still owes you the money. This 20% still owes you the money. This 80% still owes you the money. This 72,000 in this scenario just rolls back into this 2.5 that owes you the money of 196 per year.
Okay, so we don't. There's no penalties. There's
nope.
Anybody. It's just that our management was poor and we weren't able to.
We made a poor investment.
You got it. The investment didn't work out. Some are home runs, some are base hits, some are doubles, some are triples, some are strikeouts, right? And we kind of
hopefully all the other money that we invested is coming in at 11, 12%, and then we're on good.
Yeah. I think I caught some of that because it was kind of low on the mic, but yeah, hopefully we can go make it up on the other deals, right? Or other opportunities, or Jake Miller puts together an amazing financial allocation that outperforms and can catch up. So we're all as a team working together to try to go make this $196,000 a year. Not a promise, not a guarantee, right? And that could happen through a number of vehicles, one of which is real estate. So Warren and Kat, any questions on that so far?
No, that helped a lot, Brett.
Okay. So now let's imagine we're going to grab this guy here and we're going to just come over here. And you guys ever watched that movie or that show? He's got the paintbrush. They had Bob Ross. He's like, we're going to take this little tree and we're just going to color it in the right here. So we're going to take this little DST and we're going to shift this little thing over here. And we're going to say, imagine there was some debt on this property, right? And the debt was a monthly loan payment. We're going to use the year 2 version of 1801. And so we're going to try to leverage this, right? And what would that look like? Well, it's just a mathematical equation, which we're going to have to work through here right now. But remember, our cash flow was essentially $22,000 a year, right? And now this cash flow, what's going on with that? This was yearly cash flow. This looks a little low. Monthly cash flow. Yeah, so this, because 1801, right, times 12 is equal to 21,612. So essentially, if we leverage this, we would have less cash flow. So 22,740, 1769. So now we're looking at a very low amount here. I mean, the 8% pref is still building up, but the actual cash flow is only 1,769. So it's barely breaking even. And so the deficit building up is 26,551. Again, but what does deficit mean? Well, deficit means to pay back the trust, which this got to pay you. So again, it's not as if the market does 20% or does negative 15%, or hopefully it's not that big of a swing. there's going to be, we say the market giveth, the market taketh away, real estate giveth, it take away, and there's going to be highs and lows, but it's just a mathematical equation. So we're going to have $1,700 of cash flow. We're going to have 26,551. Okay. In this scenario, oh, actually, let me adjust this, right? Because in this scenario, we didn't put up all cash. Warren, what kind of down payment do you want to put down? Do you want to put down 20%?
20 and 25%.
Okay. So 354,900. Let's just do 25%. So it's 88,000. So 88,725. So the trust put up 88,725, right? Which means equal to the sum of this times this. So it's 7,098. Okay. So our deficit's about 5,329, right? You see how I got there, Warren and Kat?
Yeah.
Okay. And so then we cruise down here, and we got to adjust a few things here, right? Because our cash flow has changed, and also what was owed over 10 years has changed. It's changed to this number here, which is 28,320. Can you hold on? Actually, I'm going to pass this to Jake for a second. Hold on one second, okay? Jake, talk a little bit.
No problem. We got this. All right. So really quick, we have to understand that it can go into real estate. It can go into stocks, bonds, mutual funds, marketable securities. It can go into crypto. It can go into a lot of different things. And the formula that Brett's obviously tying out there is a potential real estate deal for our clients here on the call. But we want you to know that with all the uncertainties, of course, there's nothing guaranteed in real estate. There's nothing guaranteed in any of these other assets. This is for those people who have a desire to continue to invest, and they're still in the accumulation phase. A lot of financial advisors talk about accumulation. They talk about distribution. We have what we call serial entrepreneurs who continue to invest and reinvest and reinvest. And that's where the Deferred Sales Trust probably has the biggest wins, because it allows for the continual reinvestment of one asset into another without incurring that taxable transaction, because it keeps all of these transactions at arm's length from you as an individual.
Perfect. Thanks, Jake. Okay, right back into it. Sorry about that little break there. And I'm looking at, I'm sharing my screen here in just a second. Let's see if it loads. Okay, so back to 1769 is the yearly cash flow, but what's accumulating is a 7098. So, and imagine that was over a 10-year period of time, right? So equal to the sum of this, and of course, Warren and Kat, I'll share this with you, times 10, right? You could say 70,980 was the number, right? That was the 10 years. I think that was already there. Whoops. That was actually the number, 70980. And if we were to sell for the $1 million, which again, I don't think that's going to happen, but you could follow the math all the way down to what would be owed to you, what would be owed to the trust, and who would get the preferred return first. Preferred meaning whatever's the first amount goes to the trust, right? It goes back to pay you. And so, if it didn't perform, it would go to zero. Now, the one thing we should mention on this too, we're like, why would you do this? There's not a lot of cash flow. Well, you get depreciation. Okay, so depreciation can offset cash flow on the property and potentially the DST income. Okay. Which is pretty cool. And so depreciation on this new purchase of $345,000, right? You have a 27.5 year for residential or multifamily cycle of depreciation schedule, of which you could potentially even accelerate that, and you could get some of that up front. So let's just do a rough number. Let's just take $350 to keep it simple. Buy it for $350, okay? And 20% of the land is typically not depreciable, right? Not depreciable because it's land. It's not something that's a building above it, right? But 80% typically is. And you could do what's called cost segregation, which is also known as accelerated depreciation. And that can give you up to I would say a rough number of the 80%, it gives you about 25% in year one. Okay, so if we take 350,000, 80%, and then we take that by 25%, that's potentially $70,000 of year one depreciation. Okay, and remember, they're selling their property. Their adjusted basis, or Warren and Catherine, your adjusted basis is, I think, about 200, maybe even lower, right? I don't remember, but think about that, right? We just put you in here with only $88,000 as a down payment from the trust that you would have paid of tax anyways, right? Because your total $960,000 was your tax liability. Okay, and we just did a ninja flip and got $70,000 of depreciation. Do you see that, Warren and Kat?
Yeah.
Yes.
Okay, that's pretty cool. Now, cost seg will cost you some money. I don't know. Let's just estimate $2,000 to $3,000, right? So there's some cost to that, and the DST costs some money, right? You're looking at about 1.5% setup fee on the gross sales price, and then you're looking at somewhere around 1.85 to 2% annual. But the goal is to earn 10% overall to net you 8% of all recurring fees. Okay. Now, this is the part where I think you guys really want to understand this. If you're 100% passive, this is winning right here, right? Right? 100% passive. But once you go active, this 80%, I mean, this could be 100% return. Imagine it was. That goes to Warren and Kat. Why? Because you're the owner of the LLC, whereas over here, you're the lender to the LLC. So this is what we call this lendership, okay? It's a hybrid between you're a lender, but now you're an owner again. I have partial 8%. Now I have more upside opportunity, right? All within the DST as the vehicle, kind of like an IRA, kind of like a 401k, kind of like a 1031. That's unlocking this lendership. Are you seeing that, Warren and Kat?
Yeah.
So can I summarize what I think you're saying right now?
Sure, Pierce, go for it.
Okay, so essentially with this particular deal, with the cash flow not earning, you're earning at about 7% possibly on this. They're essentially going to just get paid off of the proceeds in the trust, off the note that they set up. So whatever the deal or whatever the investment opportunity is that's not really not really meeting that requirement, it's kind of like, I don't want to say the trust's problem, but essentially they're going to get their cash flow from the note that they have. And then they're also going to get the depreciation. They're not necessarily getting the cash flow from the actual deal in this particular situation. Is that a fair statement?
You nailed it. So it's not just about cash flow, it's about tax flow, right? And so for 25 years, Warren and Kat have invested, and it's been all about cash flow and all about appreciation, which again are still vitally important. But guess what? They're maximizing their cash flow now on their deal, right? It's ready to harvest. 10 years ago when they bought the property, it was worth 1.2 and the rents were 800, 700. Now the rents have jumped to 13, 14, 1500, all-time highs in rents, which guess what? The value goes all-time highs. So it's like you're sitting on this oil rig, right? And you want to pop the oil rig to go make some money, but until they sell and get it over here, tax deferred, right? So that's part of it. The other part of it is you mentioned is a new depreciation schedule. So Robert Kiyosaki says it best. He says the purpose of a business is to own real estate. I'll say it again. The purpose of a business is to own real estate. And you could take that to the purpose of owning cryptocurrency is to sell low, to buy low, sell high, to what? To go buy real estate. Part of why? Because you can get that depreciation, right? The government is in the business of incentivizing us to own real estate to get depreciation. But this is part of why the Blockbuster 1031 is not great, because what? The old low depreciation schedule travels. So you want to look at basically like 3 or 4 like pillars of your wealth plan: cash flow, appreciation, liquidity, right? Diversification. I'll call like 6 pillars. But then like depreciation, right? That's huge, right? Depreciation. And then do it all in an environment that's very tax friendly. Does that make sense, Pierce?
Yeah.
And it's increasingly not tax friendly, right? Biden's administration, they want to take capital gains tax from 20 to potentially 25 to 26 to 28. They've talked about taking away the 1031. It doesn't look like they're going to take it away. That's a good thing for all of us who love real estate. Rebecca, do you have any thoughts or comments? You've been. I want to bring you in here. I want to see what you're thinking here. You can unmute yourself.
I love this. I love that, there's the opportunity to, if you want to get back in the nitty gritty with the LLC options, but if not, to be able to take a step back and just earn that 8% coming in with your money. It's guaranteed.
It's not guaranteed, just so you know, because we got to go make it, right?
Right.
Not guaranteed. It's not, but can we put it into certain investments that are very low risk and as close to guarantees as we can? Yeah, but is that going to be 8? It's probably going to be lower than that. This is why we want to diversify. Right. But a good way to think about it, it is passive. And if it's diversified well enough and managed well enough, right, then is it better chance for you to achieve that versus doing it on your own? And that's the difference. Does that make sense, Rebecca?
Oh yeah, definitely. Love it.
Excellent.
I do, Brett, have another question.
Sure.
So we're active. We have this LLC. We sell the house and we make money. And does that add to our capital gains tax basis?
Great question. So let's say we do sell this thing for $1 million, right? And this 80% is 459 or about 460. You're like, oh no, we got this capital gains tax in. Yeah, it would. Like you could take that and pay that tax, or guess what you can do? Isn't this so cool? There's one more bonus. You can roll this into the same DST. So you roll this 459 up here. 459, 296. And now it's in the same DST. It's actually note number 2. So the total DST assets, total amount, total DST equals the sum of this plus, oops, try that again, equal to the sum of this plus this. Okay, so now there's 2.9, and guess what you can do? You can get 80% of it, go buy more real estate when it makes sense. Start a business. We just did a cryptocurrency deal for $5 million. She's starting her business with her long-time college roommate. She worked for Google for many years, W-2 tech expert. She's like, I'm done with corporate Google. I'm ready to do my own thing. But she bought Bitcoin for $30,000. She's Jake and Mai's client, and it went to $50 million. So her outcome was, let me sell some, but oh no, I have tax, but I want to do my buddy's business. Oh, perfect. I can do a hybrid. DST, defer the tax, and get into the business, right? So go buy more business, or real estate. Go buy more businesses.
And here's the thing. I mean, we've got an entire world of marketable securities, so that until you have that next good deal that comes along, that next new business, that next new piece of real estate, we can be taking advantage of this waiting period in the market in a very conservative way. When I say in the market, a lot of times the market is scary for people, right? But let me just tell you that there is so much available in the market that it is fairly easy for us in the interim to be making 10, 12% for you conservatively while we're waiting for that next big deal to come along. And so from like a corporate asset management standpoint, we're able to effectively make good use of those dollars while they're waiting for that next big deal.
So well said. But Kat, does that answer your question? I want to make sure.
Yeah, it does. And what it says to me today, in today's world and the prices today.
So speak really clear. Again, the Amazon, it's going to be actually it's going to be a Thanksgiving present. Can we do those now?
I don't know why my voice doesn't carry yet, Warren.
I don't hear when she talks to me in person.
You should just buy one now.
Okay, so I guess what I'm taking away from this today, in today's world, right now, this doesn't make sense. I wouldn't buy this property. I wouldn't go active. I wouldn't make an LLC today with one property the way these prices are. But the beauty of a DST is you hold on, you wait, hopefully prices go down. Then this particular example might start to look promising and getting an 8% return.
That's the Monday morning quarterback, right? Drop back, diversify, pay off debt, tax deferred, and liquid investments like Jake Miller, right? Like he's saying, wait. And then guess what? I'm going to be looking turnover rocks. Pierce is going to be turnover rocks. Rebecca's going to be turnover rocks. Doug, who's a real estate professional, rocks. Jake, we're all going to be trying to find opportunities and deals that we know, like, and trust from people we know, like, and trust, and deals that we know, like, and trust when the timing makes sense. And that's the biggest kept secret of the Deferred Sales Trust. It's the foundation of our company. It's why we're here. And it's why it's transformational for our clients. And then even more so, it works for real estate. Real estate has a 1031. Crypto doesn't have a 1031. Bitcoin, Ethereum, XRP, they don't have 1031s, right? They have nothing except for maybe giving it all away to charity, which, again, you could do that. Or you can do opportunity zones. Those are opportunities, but you're technically just putting it all into one deal or maybe two, and you don't get any access to the capital for 10 years, really. So, I mean, there's pros and cons to every strategy. We just believe that the Deferred Sales Trust, now more than ever, was designed and created for a time like this. I had clients sit in the bank for months during COVID-19. They're like, I don't trust the real estate, stock market, crypto market. I don't know any of that. Okay. Sit in the bank. I mean, I didn't like it because, inflation was eating them up, and we told them to buy low because, everything was on sale, especially in the stock market. But that being said, it's your money, and you make the decision on when and if it's going to actually be invested. You have to approve everything. We're just here to help you make great decisions, here to help you find good opportunities. Think of us like your executive team. Jake Mueller, financial advisor, me, the trustee, the tax team as the tax professionals, all working as a team to help you create and preserve our wealth. And we have to, right? Otherwise, the government, they just keep eliminating stuff or limiting stuff or increasing taxes, and the wealth just gets depleted from, I say, my family, your family, our clients, and they waste it away and it's gone, right? But they give us these legal loopholes, and they always have. Why? Because they want to spur economic growth. But unless you know about them and you're confident, and this is why we're here, so you can come every single Friday, bring a friend, bring your CPA, bring the biggest skeptic. I like to say everyone's a skeptic, and it's like Mike Tyson, right? You ever see that one? He's like, everyone has a plan until they get hit in the nose. It's like everyone has a plan until they get hit in the nose by the government who's going to take the tax, right? So why not figure it out, ways to legally defer, and that's why we're here. So.
Very good. Well, that's a pretty good wrap up as well. We're coming at the very end of our show today. Brett, final things that we want people to know.
Just maybe remind them where they can find you, and I'll remind them where they can find me, and then Pierce as well, and Rebecca chime in, and Doug, you're welcome to as well. Doug's a part of the EXP family as well. Doug, you be in Vegas, by the way?
Yes, sir. I'll see you guys there.
There it is. I love it. Now, Pierce has a legitimate excuse. Pierce, can you tell everybody, just so it's on the record here, what's happening right now?
Yeah, we're going to have a baby any day. So that's
yeah, there you go. Congratulations.
I was planning on going when I was talking to Brett, and my wife looked at me. She's like, don't even think about it. And I was like, all right, that's...
Can you imagine it? We're at the gala dinner, we're at the big dinner, the big conference, and Pierce is like, oh no, she actually went into labor. Like, Pierce, what are you thinking even getting over here? You can't just drive. It's not like cross town. Although he used to live in Vegas just as of a year ago, and then moved to SoCal, so it would have been perfect had you still been in Vegas, but
Yeah,
She's still going to yell at you.
I know. I got yelled at the other day for not putting the car seat in the car, and then she took it out. So,
hey man, she's the boss,
on her
man.
thing, man. She's ready to go. So
she tells you to jump, you just say how high.
Yeah.
Okay?
Yep.
So Pierce, where can people find you if they want to find you?
KingdomLuxuryRealty.com. Anna actually was the one who designed and made the website, so she's kind of like my marketing guru
extraordinaire.
Website developer.
Awesome.
She's hopping on board and giving us a try. So I got her for a month so far on a trial. So hopefully she likes it and wants to stay. she's a rock star. So
Fantastic. How about you, Doug? Where can they find you?
Well, like you, Brett, I work in the Sacramento MSA, and I can be found at doug@douggrace.com.
Fantastic. Doug's an amazing realtor, Sacramento, for many years. Rebecca, where can people find you?
They can find me at rebecca@rebeccamunson.com, and I'm in the Truckee and North Lake Tahoe area. Yep.
Fantastic. Luxury realtor. Amazing. Jake, where can people find you?
alphamarktax.com, alphamarktax.com, or 1-800-773-1848. Happy to help out. Any questions people have, Brett and I, we're here to discuss the DST and how it fits in your specific situation.
Fantastic. And folks, want to reach out to me, you can go to capitalgainstaxsolutions.com. You can also search on iTunes, Spotify, of course, YouTube, subscribe to our channel. We're up 700 subscribers in the past 30 days, people. Like, boom, we're growing. So please invite friends and family, anyone you want. The community is wide open. We love financial advisors, CPAs, commercial brokers, luxury realtors, cryptocurrency experts. Come on back next week. We'll have another show. I'll probably be streaming live from the airport or Vegas, but Jake or Pierce, actually, you might have to be the ones. We'll talk about that later. So thanks everyone for listening, and we will see everyone again real soon. Bye, everybody.